Welcome to our next webinar in the series from Wilkin & Gunplan for condominium associations. My name is Mohammed Saliani, and I'm going to be your moderator for today. The topic for today is what can you learn from your audited financial statements? So we have two speakers today. We have Joe Chorba and Nicholas Haralambopoulos. Both of them are managers in our firm. Joe has been with the firm for about 15 years, and Nick has been with the firm for about 11 years. As I said, my name is Mohammed Saliani. I'm a principal here at Wilkin & Gunplan. So before we get started, we have a few housekeeping rules for you. First of all, to ask any questions, please use the questions pane in the GoToWebinar dashboard on your screen. We will try to answer as many questions as possible. And if we cannot, we'll try to follow up with you and have your question answered after the webinar. We will be polling our audience throughout the presentation. This will help us get a sense of the participants and their experience. This webinar is being recorded and will be uploaded to our website, www.wgcpas.com, and will be available in a few days after the webinar. So we have our first polling questions just to get an understanding of who is it that's listening in to the webinar today. So who's in the audience today? Do we have board members, managers, committee members, like, for example, the audit committee, the finance committee, things like that, or just other people listening in? All right, so we're going to give you a few more minutes, a few more seconds just to vote in. I'm hoping that everybody can vote in. All right, I think we're going to close that over. So it looks like the majority are managers, and we do have a few board members as well, and some others listening in. So hopefully you can gain some knowledge from this webinar, get a better understanding of your financial statements, and how you can utilize them going forward as a tool for your association. All right, so take it away, Joe.
Okay, thanks, Mohammed. Okay, just before we get started, Mohammed mentioned, submitting questions for us to answer throughout the program. Please submit as many questions as you want. This time is for you. We want to hear what your questions are and try to address all of your needs and things that are fresh in your mind. So ask as many questions as you can, or because I'm sure whatever question you have, I'm sure you're not the only one thinking of it, and we'll try to get to as many as we can. So today we're going to walk you through the audited financial statements. You've probably been through this before, but we're going to go into a little bit more detail, and we're going to talk about some of the clues and some of the indicators and some of the things that we look at when we're trying to evaluate the financial condition of a particular association, or maybe trying to look for things that a board or management need to address or should be addressing as part of their management of the association. So for this program, we're going to try to familiarize you with the different parts of the audit and the audited financial statements. We're going to break down some of the common financial issues that associations face, and then we're going to try and point out some of the clues, some of the things to look for when going through a set of financial statements, and what to do when you find those clues. So what is an audit? What does an audit consist of? So there's a few questions that we're going to answer throughout today. What does an auditor actually do? What's really in an auditor's report, and the distinction between an auditor's report and the financial statement. So a lot of people don't understand that even though they're all part of one report, there's two very distinct sections. One is the auditor's report, which is the auditor's responsibility, and the rest are the financial statements, which are the board's responsibility. And Nick's going to go into that in more detail in a few minutes, but we'll talk more about what's in the auditor's report, why it's there, what to look for in the auditor's report, and how you can use that as part of your management. And then moving on to the actual financial statements, the numbers and the meat of the report. What does that tell you? What does that tell you about your financial situation? How can you use that information to make better managerial decisions? We'll go through the different parts of the audit, or the entire report. And then we may even talk later about some of the other reports that you may get, things like if we have time at the end, I don't know that we incorporated them into the slides, but if we have time at the end, we can talk a little bit about your management letter and your rep letter, and how and what information you can get from those and the purpose of those. So, so just to go through the different components of the main report that you get. There's one is the Auditor's Report, typically the first 2 pages of the report. It talks about things like what we did, that we did our audit procedures in accordance with generally accepted accounting principles, and who's responsible for what. And we talk a little bit about, there's a couple other paragraphs that are common to community associations, things that are supplemental to the basic financial statements, supplementary information. We're going to go through that and what to look for in those. Then the basic financial statements consist of the balance sheet, the income statement and changes in fund balances, the footnotes. We're going to spend some time on the footnotes. So those are, not that they're overlooked. I think people tend to spend a little less time on the footnotes, but the footnotes are very important to the financial statements because they support what's going on, and they give you a lot of information that may not necessarily show up in the numbers in the balance sheet and the income statement. They may not show up in the regular operations. So the footnotes are very important. And then, like I mentioned, there's 2 very common reports that you'll find in a statement with the financial statements for an association, which is, one is required, and that's your summary of the replacement study that was done by your engineer. And one is not required, but it's still very common. We put it in all of our financial statements. That's other supplementary information. And I think Nick might be going over that later on in the program. So that's what we're going to do. Hopefully, we're going to give you some takeaways and some things to go back to your financial statements to look over and see if there's anything that can help you in your management going forward. So just to start off, we're going to start off with the Auditor's Report. I'm going to let Nick take this away and walk you through that.
How's everyone doing today? My name is Nick Carolambopoulos. Mohammed had the very easy task of pronouncing my last name. As Joe mentioned before, we're going to talk about a couple different parts of the audit and the financial statements. The goal of this is to really point out some clues when you get your financial statements. Hopefully there's some things that we can highlight and show you when you have your own set of financial statements to go through. I'm going to start with the Auditor's Report. Most Auditor's Reports that you will see will really be broken down into 5 main areas, which are included in the below bullets. They are the board's responsibility with respect to the financial statements, the auditor's responsibility, the auditor's opinion on the financial statements. These 3, I'll go into a little bit more detail in the next slide. The last bullet is really the other 2 main areas, and they relate to supplementary information, of which one is required by GAAP and the other is optional, but as Joe mentioned, we usually provide it for the board's convenience. Accounting principles require that the information on future major repairs and replacements, more commonly known as that's your replacement engineering study, be presented as supplementary information. So that's required to be included in your financial statements. As part of the audit, we just provide a summary of this supplementary information and we disclaim an opinion on that. The reason why we don't provide an opinion on the replacement study is because we're not engineers. We don't know the exact cost or estimated useful lives of the association's components of the common property. Therefore, we just summarize it and we do a disclaimer of an opinion on that information. Lastly, many auditors' reports contain a report on other supplementary information. That's that budget to actual variance that Joe was talking about. This is usually included at the end of the supplementary information. Just one thing of note before we move on, these are the five items mentioned above are just the most common types of items you'll see. However, just note there can be additional items included in the auditor's report. That's really outside the scope of this presentation, so I won't go into too much detail about those. Continuing on with what exactly is included in the auditor's report, A lot of the questions we always get is who is responsible for what? It's a common misconception in the industry that the financial statements are really the responsibility of the auditor. However, the financial statements ultimately are the responsibility of the board. Even though management is involved in the day-to-day activities and the auditor helps in preparing GAAP financial statements, the board is the one that is responsible for approving contracts, approving invoices, signing off on invoices, approving meeting minutes. Therefore, these financial statements are not the responsibility of the auditor or manager, but rather they're the responsibility of the board. So just note that the financial statements at the end of the day are the responsibility of the board. Moving on, the auditor's responsibility is to express an opinion or opine on these financial statements. And again, that's based on our audit. Our opinion will include whether or not the financial statements have been presented in accordance with GAAP. And in most cases, the auditor will help in making sure that these financial statements are presented in conformity with GAAP. I think sometimes that's where a little bit of the confusion, where some of the board members get confused as to the responsibility of the financial statements. More importantly, when the auditor expresses an opinion on the financial statements, we're giving an opinion that these financial statements are free from material misstatements. The key word there is material. As part of an audit, we don't look at every transaction or every invoice. Instead, we look at items that will have a material impact on the financial statements. For example, we're not going to look at a $75 office supply expense for a condo association that has maintenance fees of over $1 million. That $75 will not have a material impact on the financial statements. So again, when we give our opinion, we want to make sure that the financial statements are free of any material misstatements. A good thing when reviewing the financial statements, the board should always take a look to make sure all material transactions are recorded in the financial statements and/or the footnotes. As for the type of opinions, there are a few different types of opinions that can be included in the auditor's report. The last bullet, that's really what is referred to as an unmodified, or more commonly known as a clean opinion. The opinion paragraph, in my opinion, is probably the most important because it gives the reader some kind of assurance that the information contained in the rest of the report can be relied upon. And a typical clean opinion states below, the financial statements present fairly, in all material respects, the financial position of the association as of a specified date, usually the association's year end, and the results of its operations and cash flows for the year then ended in accordance with accounting principles generally accepted in the United States of America. So if you see that on your financial statements, that was a clean, unmodified opinion. There's a couple other different types of opinions that you might see, qualified opinions, disclaimers of opinions, adverse opinions. These are usually you'll see when there's a scope limitation or there's a departure from GAAP. But for the most part, you'll generally see an unmodified opinion on your financial statements or in the auditor's report.
Thanks, Nick. And this is Joe again, just to expand on what Nick was saying, on a couple other things you can look for in the auditor's report or the opinion letter. Another thing that might be common when you're looking at an association or you're looking to purchase a unit or whatever it may be, there's some things that may show up in the supplementary paragraph when we talk about the reserve study. So one of the, it's fairly common to have a clean opinion, like Nick states. There may be certain cases where we have a scope limitation, where the scope limitation really, the limitation would be anything that would prevent us from completing our audit work would be considered a scope limitation, whether the records were incomplete or there were, maybe there was a board that didn't feel comfortable signing the rep letter, things like that. That may pop up from time to time. But what you may see in the supplementary paragraph on the reserve study is you may see wording that says we have unresolved doubts due to the age of the study. And we'll go into the replacement fund a little bit more in detail later when we talk about the footnotes in the replacement study and the actual supplementary information. But just right off the bat, even though we're not required to express an opinion on the contents of the study, we still have to do some limited work on it. We still do things like test the mathematical accuracy of some of the schedules. We talk to maybe the manager or the board just to make sure that certain components were considered or included. We also take a look at the beginning balance that the engineer used to make sure that all of their assumptions and the actual dollar amounts that they're using in their calculations are correct. And we also need to state whether or not that information that we're summarizing is still timely. So, you know, if you have an old study that's usually over 5 to 6 years old, a lot of things could happen since that study was prepared. So, due to the age of the study, we have to state that there could be doubts surrounding the study because it's not a current study. So that's just one thing to point out, that you may see that in your financial statements, but that's probably the more common modification that we make to the report, other than the standard wording. And then other than that, from time to time, you may see a scope limitation or a qualified opinion. Okay. So now let's move on to the balance sheet. So if you hear any of us at board meetings, you probably hear us say a lot that when we get to the balance sheet, that it's a snapshot in time. I usually say that a balance sheet, well, a balance sheet is as of a specific date. So when you get your report, it's going to be as of the last day of whatever accounting period it is. Usually December 31st is the most common, but if you have a year end other than that, it'll be at whatever the last date is of your year, your budget year, whatever it is. And I usually say it's what you own and what you owe. So you have your assets and your liabilities. So in the assets section, it's pretty straightforward. You have things like cash in the bank, CDs, investments, how much unpaid maintenance fees you have from the owners, prepaid expenses, interest income on the investments, and we have that other tricky line that comes up quite often is your interfund balances. So we're not going to, we'll touch a little bit on your interfund balances and what that could indicate, but we're not going to spend too much time on what creates them. I think what we'll do is we'll spend more time on what to do when you have one, and what that could mean if you have certain interfund balances. Your liabilities include things like your accounts payable, assessments received in advance, which is the prepaid maintenance, a loan if you have one, things like that. And your fund balances are basically the funds that have accumulated over time, either a positive fund balance or a negative fund balance being a deficit. But those are your balances that you have in each fund, that basically what's available to be spent in the upcoming year, subsequent to the balance sheet date. So how much do you have in reserves, deferred maintenance, and operating? Hopefully it's a positive in the operating and you're not running at a deficit, but we'll talk about that too. But a lot of what we look at when we look at a balance sheet has to do with cash management. Cash flow can be a tricky thing with associations, making sure that you're charging the correct amount of maintenance, that your unit owners are paying their maintenance fees. Are you able to pay your bills? Are you able to properly fund reserves? So there's a lot of things you can find on the balance sheet. So to start off, operating cash compared to accounts payable. That's the first cash flow indicator that we like to look at, just to see if you're able to meet your current liabilities. If you have enough cash on hand to pay your outstanding payables. Interfund balances I'll come back to in a second. If you don't have cash on hand, why enough to pay your payables? Things like maybe you have an accounts receivable or a collection issue where you have a lot of unpaid maintenance fees where that's preventing you to have cash in the bank to pay your bills. So it's actually the last bullet on here. I'll go to that real quick. But your accounts receivable compared to your assessments received in advance. Ideally, we like your AR to be 0, but we know that that'll never happen. But at the minimum, for cash flow purposes, it's nice to see that your prepaid maintenance is at least equal to your assessments received in advance. So that just means for cash flow purposes, whoever's paying in advance, again, for cash flow purposes, whoever's paying in advance is making up for the people who are not paying their maintenance fees. So Mohammed, do you have?
Yeah. So Joe, are you going to touch on allowance for doubtful accounts? Can you explain that a little bit?
Sure, I can do that now. Now is a good time for that. So another good question is what is allowance for doubtful accounts, and how is it recorded? How do you come up with it? An allowance, well, let me back up. For GAAP purposes, GAAP requires financial statements to be conservative, which means they want to most closely reflect reality. And when it comes to accounts receivable, you may have, people owing you $100,000. But if we don't alert the reader that a portion of that $100,000 may not be collectible, then the financial statements may be misleading, or they may not reflect reality. Even though it says you have $100,000, the reality is you may not collect the $100,000. So what GAAP requires is that you come up with an estimate of how much you think might not be collected. And we do that in the form of an allowance for doubtful accounts. And all that is it's basically an offsetting account to your accounts receivable that says we have $100,000 due, $50,000, we've exhausted all of our collection efforts. The people are into foreclosure, or whatever the case is. They don't have assets, and we've tried to get as much out of them as we can, but it's unlikely that we're going to be able to collect a portion of that. And let's say that that's $50,000. Well, what we'll do is you do an offsetting account. You don't completely eliminate them because you still may want to try to collect some of that balance, but we're going to come up with an estimate, a conservative estimate of what we think may not be collected. So the number that we would show on the balance sheet would be the net of the two. So instead of showing $100,000 due, we would show $50,000 due, and we would make a note of how much of that, their accounts receivable balance is uncollectible, or an allowance for doubtful accounts. So this is one of the things that you look at and could have a huge effect on your cash flow.
So Joe, just to follow up on that, whose responsibility really is it to come up with the allowance?
Well, like Nick said, the financial statements themselves are the board's responsibility. Okay, and we're coming in to express an opinion on it and just state whether we agree that the financial statements are accurate. There's no material errors. So included in that are all estimates. And the allowance for doubtful accounts is an estimate. So even though we may do the computation, it's really the board's responsibility to come up with the methodology behind that computation and the reasoning behind it, because they're the ones that are responsible for that estimate. So a lot of times we'll start with something very basic, like a percentage of the over 90-day balance, and that as a starting point. But ultimately, when the board signs off on the rep letter, reviews the financial statements, and goes over these financial statements with their auditor, they're the ones that are taking responsibility for those estimates.
Yep.
Okay. So another negative to cash flow is your operating deficit. So we do not like seeing operating deficits because it affects so many things. So you want to make sure that your association is running at a break even, or even having some surplus to help with their cash flow and providing you the cash to pay your bills, to fund reserves. If you have an operating deficit, one of the most common temporary solutions to it is to not fund reserves, because you still have to pay your landscaper, you still have to pay your management company, you still have to pay all of your vendors. And in order to do that, either you don't fund reserves or you borrow cash from reserves. So you want to make sure that you're addressing deficits should they arise. So the interfund balance is real quick. I just gave you one very common cause of an interfund balance, and that's not funding reserves. And basically all that, the interfund balance just reconciles what funds owe each other. So how much does the operating fund owe the reserves, or vice versa? So if you're not funding reserves because you need that cash to pay your bills, well, that's going to create a due to the replacement from the operating fund, which is also an interfund balance. So an interfund balance could be an indication of cash flow problems, which could be the result of an operating deficit, or people not paying their maintenance fees, things like that. Okay, so let's see what else. So next, the next part of the basic financial statements is your income statement and statement of changes in fund balances. So what does an income statement include? So it's basically it's your income and expense activity for the year, broken down by the different funds that you have, whether you have a replacement fund, deferred maintenance, a transition fund, an activity or a club fund. It shows all of the activity for the year, how much money was earned or billed in maintenance fees, and how much was paid out to your vendors, or how much did you incur in expenses during the year. So it provides insight to your operating performance for the year. Each fund will have either a surplus or a deficit. That's where the changes in fund balances come in. It'll either be at the bottom of your income statement or it'll be a separate statement. And that shows you how much each fund has accumulated over time. And the last point there should be viewed in connection with your statement of changes in fund balances. And your statement of changes in fund balances include the balance of the beginning of the year, the additions or reductions during the year, any inter-fund transfers, and then balances at the end of the year. So it's your beginning balance plus whatever your net income or deficit was for the year, then any adjustments that you made gives you how much is available to you at the end of the year. Now, your inter-fund transfers can be things like, let's say you have transition expenses, or you wanted to do some upgrades to the pool, maybe buy some pool furniture, or whatever it may be, where let's say you want to use working capital funds for it, you would transfer some of the funds from working capital over to the operating fund, or wherever the inter-fund transfer would be. So that's just an adjustment to show how much you have in each fund. So on the income statement, now that we know what it includes, what are some of the things to look for? So on the income statement, you want to see whether or not you have an operating surplus or deficit for the year. And if you do have an operating surplus or a deficit, it's important to understand why. What are the causes of your surplus or deficit? Was it a one-time thing? Is it something that's recurring every year? So if let's say it's like it says here, circumstances outside the control of the board, like a weather event, a snow, heavy snow year, or some other type of weather events, like whether it's a hurricane or something to that effect. Is it a one-time thing? Was there something else that happened? Did a pipe burst and your water charges for that particular year are through the roof, and you had to incur repair charges to repair a water main? Those are things that can be addressed fairly easily because they're outside the control of the board. So if there's a need for a special assessment, it can be addressed and should be addressed quickly to address them and get them taken care of, to address the deficit. But the other more concerning deficit would be one where it's happening year after year, and that could be an indication of a budgeting problem. I know a lot of times I sit at board meetings and they don't like increasing maintenance fees, or they are not realistic on how much it costs to manage the association on an annual basis, where they say, well, even though repairs and maintenance have been X for the last couple of years, we think next year is going to be better. Those are a little more of a concern because that's something that is a little harder to address. By not increasing your maintenance fees year after year, you could run into a problem with having a large increase to make up for it, and it doesn't provide the cash. You end up with cash flow problems, and maybe you're not funding reserves, and it just creates a lot of problems throughout the financials of the association going forward. So keep an eye on that, understand the reason for the surplus or deficit, and make sure you address it appropriately. Cumulative fund balances, we talked about that, accumulated deficit or surplus. and the replacement fund. I want to spend a little time on the replacement fund because there's things that you need to look at in the replacement fund balance. So, and this is something that we may do as part of the audit, but you want to compare the replacement fund ending balance to what is projected in the study. The study projections are just that. They're projections, they're budgeted amounts, they're estimates. So you want to make sure that your ending balance is you compare it to the study and make sure that it's close. And if it's not, understand why. Did you redo the roof earlier than the study anticipated, which means your balance is less than what the study shows, or was the beginning balance off to begin with, which then you're behind, or things like that. So compare it to the study. Then once you have that balance, then take a look at what projects are anticipated in the study so you can forecast what your cash flow needs are going to be for the next couple of years. So that, make sure that you have enough funds on hand, that if you're invested in CDs, that you make sure that they are mature in time to have enough cash on hand to fund the project. Is there a need for a special assessment or an increase in contributions? So these are all things to look for when you're reviewing your study and evaluating your fund balance to make sure that your fund balance is where it should be. So next, I think we have another polling question. I'll let Mohammed go through the polling question with you.
All right. So here's our second polling question. What are the association's options for replacing a common element that is not included in the engineering replacement study? Say, for example, if you have ponds and you have to suddenly realize that you need to replace the aerators and you don't have the aerators in your replacement study, or you don't have enough of them. So here are the options. Pay for it with operating funds, pay for it with replacement funds, and update the study to include the component for funding of future replacements, pay for it with deferred maintenance or working capital funds, all of the above. All right, so we're just going to give it a few more seconds here and try and see, let people decide. All right, okay, so we're going to close it now. So we do have people pulling up, giving answers all across the board, but 50% of the people said all of the above, which is actually the right answer. You can, now that you realize that this item is not in your replacement fund, you can actually pay for it either of the three ways that are up there. However, you do need to realize that you've replaced this item, and if the item has a useful life within the replacement window of your study, you will need to update your study anyway to make sure that you include it in there. So if you use the operating fund for now, that's fine, but next time you have the study updated, make sure you put those items in and see that you fund for it. If you use the replacement fund, basically what you've done is you've taken money that you've put aside for other items, and now you need to refund those items to make sure that you have enough money to pay for those when they need to be replaced, and to fund for this when it needs to be replaced again. And C basically is the same answer as A, kind of, but again, you need to update the study. So any of those will work, but make sure you update the study to include those items for the future. All right? So we'll move forward.
Footnote. Now that Joe has covered the numbers included in the financial statements, let's take a look at the footnotes to the financial statements. One of the best and most useful things about footnotes is that they provide information to support the numbers included in the financial statements. Most financial statements will start with some sort of note that will provide information about, the makeup of the association. This will include things such as where the association is located, how many units it consists of, the number of developer-controlled units, if any, and lastly, the recreational facilities or amenities of the association. Also, this note will include if the association is under a master association. Moving on, the footnotes will also provide the significant accounting policies used to account for the financial activity. One of the most important ones that you will see is the fund accounting note. This note will explain the use of the operating fund, the deferred maintenance fund, the replacement fund, and any other funds that the association may have. This is a good footnote for new board members to take a look at to really see what each fund is used for. Continuing on with footnotes, they will provide information also about specific line items included in the financial statements. Again, these will support the numbers in the financial statements. Most, if not all, of all financial statements will include a line item about income taxes. Associations can be taxed as either a homeowners association or a regular corporation. This note will identify how the association expects to be taxed and the amount of income taxes for the year, if any. The municipal reimbursement note, this note will detail the agreement that the association has made with the township in regards to reimbursement for various things such as street lighting, leaf removal, and snow removal. One important thing, remember as Joe mentioned before, those clues in the financial statements, one important thing to pay attention to in this note is that it will provide when the association last received their municipal reimbursement. This can be helpful for boards. If you haven't received a municipal reimbursement in 2, 3, 4 years, and you take a look at that footnote, you might want to follow up with the township in regards to that. So that's one of those clues to look for in the financial statements. Moving on, some popular footnotes will include insurance claims. This note will really detail the claim, how much we received from insurance, and the expenses incurred as a result of the claim. If the association has a loan, we'll include that as a footnote as well. It'll include the amount of the loan's interest rate, covenants, maturity date. A lot of associations have some type of working capital or membership fee policies. This will be included as its own separate footnote in the financial statements. This will let the reader of the financial statements know how much is collected at closing and which funds the working capital and or membership fees is allocated to. And then lastly, we just have a couple other common footnotes that you might see in your financial statements. There'll be rent receivers or association-owned units. Those will have their own separate footnote. There'll be a separate footnote if during the year, as Joe mentioned, if the snow was too high or for whatever reason there was, a large operating deficit, you might see a special assessment passed during the year. Anytime there's an interfund transfer, we'll usually see that as a footnote as well for the financial statements. The footnotes, they can also provide information that may not necessarily be shown in the numbers. And more importantly, certain times, this is really related to the replacement fund. The replacement fund footnote will provide information such as the age of the study, it'll estimate the remaining useful lives. This is important in that the best practice is to have that study updated every 3 to 5 years. As Joe mentioned previously, you want to make sure that study is updated every 3 to 5 years due to rising costs. The study is really just based on projections. So it's, anytime it lapses over 5 years, there's a good chance there could be some material modifications to the lives and component age of those studies. So another reason why is if the study goes beyond 5 years, the study may not become as accurate and the replacement balance might be underfunded, which you might want to avoid. The replacement fund footnote also includes, the replacement cost of common property, which is included in more detail in the supplementary information. Also in that footnote for the replacement fund, it will include a sentence that really the board should look for as to whether or not the association is funding in accordance with the engineer's recommendations. Most engineering studies will include funding recommendations based on either full funding, threshold funding, and baseline funding. Those are the 3 most common ones that you'll see. The footnote will detail which funding methodology the association is funding in accordance with. Just one thing to note, full funding is the most conservative, while baseline is the most aggressive. We normally don't recommend baseline funding since its goal is to never let the replacement fund balance get below $0. So what would it be to keep that above $1, which is, fairly aggressive. The replacement fund footnote also provides information and clues that indicate whether or not the replacement fund is adequately funded. So for example, if the association is not funding in accordance with the study and they're funding less, there is a chance that the amounts accumulated in the replacement fund may not be adequate to meet all future needs for major repairs and replacements. And that's something that you really want to try to avoid. Continuing on with footnotes. A lot of other footnotes that really may not have an impact on the numbers but are included are pending litigation or settlements. And again, this will provide information relating to any pending litigation, including claims, status, and resolution. It may indicate that monies may be due to the association, which is a good thing. It also may indicate that the association may need to pay out a certain amount of funds, which could lead to increased fees or special assessment. An example of this might be, your typical pending lawsuit with a vendor over disputed charges or work performed that was unsatisfactory. If it's a material dollar amount, or that might be something that would be included in the footnotes of the financial statements. Also, if litigation is still pending and nothing is settled at year-end or even after year-end, the footnote will state something that'll say, the outcome of this lawsuit is not known at this time, therefore no amounts have been included in these financial statements. Moving on to commitments, this really applies to when the association enters into any, multi-year non-cancelable contracts during the year or subsequent to the year. You'll usually see this in regards to the replacement fund. If you're going to replace all the roofs in the association, there's a good chance that's going to be done over a couple of years. So anytime there are those multi-year projects, we will include that as a commitment in the footnote to the financial statement. Lastly, we have subsequent events. Subsequent events really include, relevant, significant events such as a special assessment passed after the association's year-end or a large insurance claim that occurred after year-end. Basically, we want to include anything that occurred after year-end up to the date of the auditor's report. That will be material to the financial statements and will ultimately benefit the reader of the financials.
Okay, so actually we have a question that's come up here. Somebody stated that on their balance sheet, there is an amount owed from the operating fund to the reserve fund. And that amount is already included in the reserve fund balance as owed from the operating fund. Should the amount owed from the operating fund be shown as a separate line? Joe, what do you think?
Well, I think what we're talking about here are the interfund balances, right, and what I talked about earlier about the amounts due from one fund to the other. For whatever reason that an interfund balance arose, you have one. So it sounds like you have the operating owes the reserve fund a certain dollar amount. So, but what's often confused when we talk about fund balance is sometimes that's confused with funds or cash. And I think that might be what's happening here. And when you have your fund balance, that's basically what was budgeted to be accumulated and versus what was spent. So let's say you have one year where you have $100,000 that was budgeted to be contributed to the reserve fund. You had no expenses. So let's say at the end of the year, you would expect to have $100,000 in the reserve fund. You have $100,000 what we call fund balance or reserve fund balance. But during the year, you had for whatever reason, you weren't able to move all of the cash from the operating account to the replacement fund account. And let's say during the year, you only transferred $50,000 of the $100,000 that you had budgeted. So now on your balance sheet, you should see a $100,000 fund balance at the bottom as your accumulated fund balance. And then the top, you'll see only $50,000 in cash. And the interfund balance reconciles the two. So you would see $50,000 being owed from the operating fund to the replacement fund because you haven't yet moved that $50,000 of cash. So the question is, should you have a separate line in the reserve fund? I would say that separate line would be your interfund balance line. I don't think that there's anything else that you would need to show in the reserve fund balance or in your accumulated fund balance, the purpose of the interfund balance line reconciles that difference. So I hope that answers your question. If it doesn't, I know we have a few things we have to move on. If it doesn't answer your question, feel free to email us after, and we'd be happy to get back to you, or email Amanda, our coordinator, and we'll get that answered. But hopefully that answers your question.
Very good.
All right.
So we'll move on. Yep. All right. So now we have our next polling question after we've talked about the footnotes. So this question says, after the year end, the association entered into a large roof replacement project for $600,000 to be completed over 2 years. How should this be recorded in the financial statements? Accrue the full $600 on the balance sheet, add a subsequent/commitment footnote in the financial statements. It happened after year end, do nothing. So we'll give you a few more seconds to just answer this question. Some of you are, it looks like, still thinking about it. All right, so we'll go ahead and close this. Okay, so Nick, I think you've done a really good job in explaining the footnotes because it looks like majority of the people got the answer right, which is B, add a subsequent/commitment footnote in the financial statement. So the reason you're doing this is because you want to give the reader of these financial statements as accurate a picture of the financial position of the association as possible. So if, for example, I'm reading these financial statements, if it's a 2016 year end, December 31st, and it's now August, and I'm reading this, and the audit was completed earlier in the year, and this commitment was already signed, I need to know that, yes, after the year end, the association has signed this contract, so whatever amount of money that's in that replacement fund, 600 of that has already been committed to replace the roofs within the association. So as a reader, I need to know what's going on. Until the date that the audit is finalized, whatever has happened, if it's material, it does need to be disclosed if it has a financial impact on the association. All right, so we're moving forward.
All right, now we're going to talk about the required supplementary information as we spoke of before. Again, this is not part of the basic financial statements, but it is required by GAAP. And basically, this is the summary of your engineering study. It's an important part of understanding the financial condition of the association, specifically relating to the replacement fund. The required supplementary information is just a summary. And again, we don't provide any opinion on it. As mentioned in the auditor's report, we disclaim an opinion on this information since we really aren't engineers. However, as Joe said previously, we still will take a look at the information. And again, one of the major things was if the study was over 5 years. We may want to modify this supplementary information as there might be doubts to the costs and lives included in the study. And that's the most important part with that one. So going into more detail with regards to the replacement fund, the supplementary information provides the following: a summary of the components of the common property, including the date the study was prepared, a list of the components. Some of the common components that you will see will be site work, such as sidewalks, pavements, fences. There'll be a component for building, which will be your roof, interior finishing, facade, siding. A lot of times you'll see a component for some type of recreation. That'll include if the association has a swimming pool, if there's any replacements for the clubhouse, that'll be included in that. And it'll also include any other, mechanical or electrical components that might apply to your particular association. So each engineering study is, specific to the association's common components. The required supplementary information on the replacement fund will also include the estimated remaining useful life of those components. As I mentioned before, this is a good clue to take a look at. I know we just provide a summary, but that one clue is to take a look at the useful lives. And usually what we'll do is we'll take the highest useful life and the lowest useful life. So you want to take a look at specific line items that have a useful life of 0, 1, or 2 years remaining what you can do is once you identify that from the auditor's report, you can go back to the engineering study and say, okay, the report said, sidewalks only had an estimated remaining useful life of 1 year. Since that engineering study is really a projection, you want to take and see, do the sidewalks really need to be replaced in 1 year, or can you hold off on that? Or is it due earlier than a year? So that's one of the things when you're looking through that required supplementary information, to just see some of those estimated remaining useful lives on the lower end, and just compare that to your engineering study, and then see if those are actually true costs. In addition, the required supplementary information from the replacement fund will include the estimated replacement cost as of the date of the study. It will include a comparison of the total cost of all components to the current replacement fund. Just a reminder that the total cost included on the required supplementary information is the total cost of all components. I know when I go to a couple board meetings, the board flips to the required supplementary information page, which is that summary of the engineering study, and they see the total cost. It's the total cost of all the components of the association. So that's $10 million for all components. The association doesn't need that in the replacement fund as of the date of the audit. That's the total cost. This is not what the replacement fund balance should equal. Instead, it should be in line with the annual fund balance recommended in the replacement study. And again, that's usually provided by an engineer over a 30-year window. Lastly, there might be a comparison of the current fund balance to cash set aside for future replacements if it's applicable. This will most likely appear when there's a large interfund balance and cash set aside is not aligned with the current fund balance in the replacement fund.
Okay, so other than the replacement study and the required supplementary information, quite often, at least in our reports, we provide another report that is not required, and it compares the budget versus actual. So it shows how you did during the year in the operating fund or your operating results for the year. So the budget versus actual is helpful in identifying large variances. It provides more expense detail than what's typically shown on your income statement. And it's very useful in preparing subsequent budgets. So a lot of times if we have a surplus or a deficit, when I talked about looking at the income statement, if you're looking at the statements, will usually tell you in more detail why there was a surplus or a deficit for that particular year. Was it a one-time thing, or was it something that you can, in conjunction with the statement changes of fund balances, you can see if this is something that's been happening over time. But I see it as a really useful tool. One of the reports that the board is probably the most focused on a daily, monthly basis is your budget versus actual. You want to make sure that your maintenance fees are enough to cover your expenses for the year, and that you're not operating at a deficit. And this report will be a pretty good indication of how you're doing or how you did for that year. So I think that pretty much covers covers.
So we have a couple of questions that did come in. One was, so if you have in your operating fund, you have a surplus. The question is that, can the surplus be basically swept into the replacement fund so that you're kind of maintaining a zero balance in the operating fund, and whatever surpluses that you have, every year they go into the replacement fund?
That's a good question. I get that occasionally, and that goes back to seeing if you have a surplus or a deficit. And if you do have a surplus, what are your options? What can you do with that surplus? I would say, generally speaking, no. There are some things you have to be really careful when you're moving money into reserves, because there are some IRS regulations that allow associations to exclude contributions to the replacement fund from taxable income.
Right.
And they're very careful on how they word those regulations so that you're not commingling funds. So if there were ever an audit and the IRS came in and took a look at your financial statements and saw that at the end of each year you were just sweeping your operating surplus into the reserves, they could view that as commingling your operating and your replacement fund money, which could then, there have been some cases in California, it's been a while now, but there were some cases where they actually deemed the entire replacement fund balance to be taxable. We don't want that to happen. So I would say if you have ideas on, or this is something that you want to do, before you do it, please talk to your auditor to make sure that you follow the steps to minimize the risk of that happening and having your replacement fund balance be taxable. So I would say generally no, there are some ways of doing it, but talk to your auditor first.
Yeah, I mean, anything that goes into the replacement fund needs to go through the budget process. So you can't just use it as a slush fund and put everything in there anytime you have a surplus. So we have another question here. So the question here came up is that if the association has had a pretty harsh winter and we're still in the course of the year, and you know we have winter in the first part of the year, and then we of course we have the colder weather in the end of the year. If you have a December year end, so you've been through January through April, and you've had a pretty harsh winter, and up till that point you've used up a majority portion of your budget for snow removal. So when do you think, Nick, is a good time for the association to assess, if they need to do a special assessment?
I would say probably the best time to do that assessment is immediately. One reason why it'll be fresh in everyone's mind, you know, they'll have it fresh in their mind of, you know, clearing off their car and how bad the association was hit. They're more apt to pay that and not fight that. Another thing is you also have to consider the budget. That snow removal budget was done for the entire year. If you use up that, you know, the majority of that snow removal budget in the first 2 months, you still have to wait for the harsh, you know, November, December at the end of the year. So you might want to do a prorated assessment for those 2 months. And, you know, it's better to, you know, cover yourself now as opposed to wait 4 or 5 months when everyone forgets about that snow assessment. Then you're hit with the first hard, heavy snowstorm in November, and people might be less amped to, you know, pay that snow assessment. So it's, in my opinion, it's very beneficial to do that early on, immediately after, you know, a very large snowstorm, because you really want to make up that budget. And worst case scenario, if you pass that special assessment and there's no snow at the end of the year, that'll just flow through as an operating surplus, and you can use that again for your, you know, snow removal costs in the subsequent year.
All right. So I have another question that's come up, is that it's more on a tax basis. The question here is that if the association, is it being taxed on membership income, or is it only being taxed on outside sources? So it all depends on what kind of tax return that's being filed for your association. It's not a one answer fits all. And I think that's something that we can talk about after that. But if you are, basically the bottom line is that if you are filing a regular 1120, then it's outside sources. But if you're filing an 1120H, then depending on what type of income you're collecting from your members, some of that could be taxed. So I think that's about all the time that we have. I know that some of you had some questions here, and we will try and answer them after the webinar, and we'll get back to you on the questions that you have. So thank you, all of you, for listening. We really appreciate your questions. We really appreciate you listening in. I think Joe and Nick did an excellent job, and if you have any questions for us, please feel free to reach out. And we'll have this webinar on our website in a few days for anybody to listen in again, or if you want to let some others know that there's useful information for them to get from you. Thank you very much, and enjoy the rest of your day.